Welcome to the Money Answer Show with host Jordan Goodman. Whether you are starting out, deep into your retirement, or somewhere in between, the Money Answer Show has the know-how to help you. Now here's your host, Jordan Goodman.
Welcome to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Steve Sjuggerud. He is one of the founders of Stansberry Reseach, which is a major investment research house. He's also the author of several newsletters called True Wealth Systems, True Wealth China Opportunities. Welcome to the show, Steve.
Thank you for having me, Jordan.
For people who may not be familiar with you, just kind of give us a brief history of your experience in investments and how you got to Stansberry and writing the newsletters you do.
Yeah, absolutely. It's been a fantastic journey, Jordan. I've actually been able to do everything that you can possibly do in the investment world, both on the education side and on the actual experience side, and sort of seeing the world as well. So, I did get a PhD in finance, and I did my dissertation on emerging market currencies. But I think the real education that I got was actually in the real world, actually as a investment professional with customers. I specialized in international investments with clients. You know, we had a few hundred guys that specialized in international investing. So to give you an idea, we would have everyone from retail investors to large institutions calling us, looking for how to buy into China. And this is going back in the early 90s. So I started out as a broker specializing in international investing. I went on to become a hedge fund manager. I was vice president of a global closed-end fund. I worked doing special situations analysis for a billion-dollar hedge fund in New York City. But ultimately, I was actually going back to since 2001, I've been writing my newsletter, True Wealth. And True Wealth, Steve Sjuggerud's True Wealth is one of the largest independent investment publications in the world with over 100,000 subscribers. So it's been a great run. Jordan, I think you know a little bit about what I've done, and you're welcome to chime in anywhere along the way. But along that way, I have traveled the world, taken customers as far north as Iceland and as far south as Patagonia, looking at incredible investment opportunities. And I myself have traveled the world, been going to China for over 20 years, and just really seen firsthand all of these incredible investment opportunities.
So let's talk about your investment approach. You have a specific approach in how you pick investments and what you're looking for. So explain how that works in general.
Absolutely. When I look at the world, I feel like there is opportunity. There's always opportunity somewhere. You just have to be open to the entire variety of investment possibilities. Most people just look at their U.S. stocks, for example, and they think that's the only investment option, or maybe their house or something. But I feel like you have to be willing to look at everything, whether it's foreign stocks or currencies or precious metals or commodities or alternative investments. So I needed a way to sort of size up, how do you compare these things to decide which one is the best opportunity at any given moment? And over, I've been doing this a quarter century. So over time, it developed into this very simple little idea, but it's pretty powerful. The basic idea of what I look for in an investment is I want to find an investment that has three things. It's cheap, it's hated, and it's in the start of an uptrend. And if I can get all of those three things in an investment, then history has proven that my chances for success go up dramatically.
Because it can be cheap and hated and stay that way for a long time. You want to see charts that it's starting to, for some reason, turn around. Is that right?
That's it, Jordan. And the thing is that a lot of folks, I kind of joke that it's hard to have friends in the investment world for me because there are diehard value investors on one side who are only looking for things that are cheap, and then there are diehard momentum investors, trend followers that are chasing things higher. And they don't really get along. The value guys don't believe in the trend, and the trend guys don't believe in value. And so I'm kind of in this middle ground where I say, gee, let's imagine that the price of a Smith Corona typewriter, Jordan. It keeps going down every year. At some point, maybe it's a great value, right? But it keeps going down every year. I want to see confirmation of the idea, confirmation that it is a decent investment before I am am willing to buy. That's the ideal situation. Like, for example, we can't know if what was the car that was the sort of the world's ugliest car, the Pinto, for example. Is a Pinto ever going to come back as a collectible? Well, I'm sure for many, many years it went down and down and down in value, but I don't know. I'm not really tracking. I'm not in the market for a Pinto, but once you start to see the trend reverse, if you were a believer that someday the Ford Pinto would come back, maybe it is the best value in antique cars. But until you see that trend start to confirm your idea that the Pinto is a great value, that other people are buying it and that it could go up in value and you could make money on it, you don't want to be a buyer of it. So yeah, you're right. Things can get cheap and hated. Things can get even cheaper and even more hated, unless you wait for that uptrend to confirm your idea.
We're going to spend a lot of time with your current ideas, but why don't you just give us an example from the past where you picked something that was cheap, hated, and an uptrend, and how it worked out?
Well, absolutely. So, one example was in around 2002, 2003, I started getting very interested in gold. And it's a pretty funny story. My dad was always my biggest fan, and my dad's my hero. But he would always buy whatever I was recommending. He always believed in my ideas, and he said, "Steve, I've done everything you've ever done, but now that you're recommending gold, I cannot. This is the first time that I can't go along with your recommendation." And I was like, man, that tells me that gold is so hated that even my father, who loves me and follows me into every investment idea, says, I just can't follow you into this one. It was an extreme of hated back then, and as you know, it soared from under $400 to where it is today, over $1,300. A couple other quick examples were in 2008, late 2008. I for the only time in my life, stocks were hated. Lehman Brothers was crashing. The banking system was falling apart. Fear was rampant. And what I did, this to me was either the greatest buying opportunity of my life, or the world was coming to an end. Yeah. And so I made a bet. It's the only time in my life that I've actually taken all of my available cash and a home equity line of credit to essentially put all of the money I possibly could towards stocks. And this was late 2008. I was a little bit early, but I was able to pay that off with 100% gain. I was able to pay that off in about 13 months and let the rest ride. It was just an incredible moment of fear, and sort of the market was as hated as it got. And in hindsight, it really was the greatest buying opportunity sort of our lifetimes.
Things kept falling, Steve. I mean, from late 2008, it bottomed in March 2009. So
there was sort of a bottom in late 2008, and then there was sort of a nail-biting period until the ultimate bottom in March of 2009. But we did have sort of an uptrend there, and then but it was just like I said, it was an incredible moment of fear and hate. And I'll tell you one other one that people could identify with. I live here in Florida, and in 2006, everybody's getting into real estate, right? The plumbers are quitting their jobs because they're making more money putting a paint job on a house than they are fixing toilets. Everybody in Florida was in the real estate business. And by 2009, to give you an idea, this one property that I bought in Florida, I'd never bought property as an investment in the U.S. outside of my home because it just was never cheap enough for me. But in 2009, a property nearby me was under contract for $14.4 million, and I was able to buy it 18 months later in 2011 for less than $1 million. So wow. well over 90% less. It was bank owned, and I went to the bank, and the story with these bank owned properties, and I don't know if they were asking $5 or $6 million for it at the time, and I offered them $750,000 for it, and I guess the bank wanted to get rid of it. They came back at $900,000, and I took it immediately. And I recently sold that property for a couple times my money in profit. But that 2011, 2012, I mean, that was an incredible moment in U.S. real estate. Before that time, everybody thought you couldn't lose money in real estate. And then after that time, there was no one left to buy. There was no money in the market. Anybody that understood it, they couldn't have access to any money. So I think that was the greatest buying opportunity in real estate of my lifetime. And I loaded up, just like I did in 08, late 08 on stocks. I loaded up in Florida real estate, and it's worked out extremely well. And Florida real estate at this point is actually still the largest percentage of my investment portfolio.
So it takes kind of nerves of steel to do that, though, to be a real contrarian, to buy when things are, tons of fear. What kind of emotional resources do you have to buy when things are that out of favor?
Jordan, that's actually a great question. I mean, and because I've been doing this for a long time, whether it's academics or running hedge funds or learning these things. But the reality is that you are right. It is extremely hard at first to say, okay, no one else is buying, everyone else is scared, and I'm going to be the one guy that buys. And here's the evolution of it is that when I was younger, my dad was in the Navy, my mom was a school teacher, so we didn't have a lot of money, we didn't have a lot of experience with this type of thing. But as I was young, and I think I was 22 years old when I accepted a job as vice president of a mutual fund in charge of a lot of operations there. So I got an early start, but I got to see many opportunities like we're describing, but I didn't have the money myself to be able to take advantage of them. But I don't think that I had, like you said, that sort of intestinal fortitude to actually take advantage of the opportunity. But then over time, especially since I'm someone who looks at all countries and all currencies and all of these things, I'd seen enough of these situations where I'd said, geez, I really should, this is what a bottom looks like, and I need to take advantage of it when it comes. And I'd seen it so many times in my career, and then when 08 was here, it was time to take advantage of it. And same thing with 2011, 2012 in real estate. I haven't done anything to that extreme since then, but I have been adding heavily to my favorite idea these days, which
we're going to get to in the next section, actually.
Sounds great.
We're going to take a break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Steve Sjuggerud. He is with Stansberry Reseach. He has a newsletter called True Wealth. You can find out more about it at stansberryresearch.com or dailywealth.com. We'll be back after this.
We're always talking business. Talk to an expert. Call now toll free 866-472-5790. That's 866-472-5790. Voice America Business Network.
We've all been there, struggling to keep up with credit card payments, searching for a simpler, safer way out of debt. Well, here it is. Cambridge Credit Counseling is a nonprofit service that has been helping people reduce or eliminate their credit card debt for over 20 years. Most of us have made late payments and even gone over our credit limits. Before we know it, our balances are out of control, and we can barely afford to make the minimum payments. If this sounds familiar and you're ready to take control of your debts, call Cambridge right away at 1-800-897-2200 for a debt-free analysis. Cambridge will work with your creditors and may be able to reduce your interest rates and get you out of debt fast. In fact, Cambridge's typical debt management clients save almost $150 every month on their credit card payments, and they're debt-free in just 50 months. So there is a simpler, safer way out of debt, and it all starts with Cambridge Credit Counseling. Call 1-800-897-2200 for your free debt analysis. Cambridge Credit Counseling is a Massachusetts-based nonprofit agency providing services nationwide. For complete licensing information, visit them online at cambridge-credit.org. Jordan Goodman is an affiliate. He recognizes quality solutions, forming relationships to help improve the lives of his listeners.
Has your small business been turned down for a loan by the bank? Is lack of capital hindering your business growth? Small businesses unable to obtain bank financing or tired of merchant cash advances can now get the financing they need. Corporate Lending Solutions provides short and long-term capital, revolving lines of credit, and unsecured business loans. Does your business need help with payables, supplies, or payroll? Corporate Lending Solutions has powerful programs to help. While getting a small business loan can be a long, daunting process, with Corporate Lending Solutions, it's simple and takes only 1 to 3 days. Call 800-261-6478 or visit corporatelendingsolutions.com to learn more. 800-261-6478. Jordan Goodman is an affiliate. He recognizes quality solutions, forming relationships to help improve the lives of his listeners.
We're always talking business. Talk to an expert. Call now, toll free, 866-472-5790. That's 866-472-5790. Voice America Business Network.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Steve Sjuggerud. He is a founder of Stansberry Reseach, editor of several newsletters, particularly one called True Wealth. You can find out more about it at the website dailywealth.com, or the website for the entire company is stansberryreseach.com. Welcome back to the show, Steve.
Thanks, Jordan. This has been great.
So one of your big themes is China. As you said, you've been going there for a long time. Before we get to some of the specifics, why are you bullish on China as an investment opportunity?
Oh man, there's so many reasons, but and we'll get to one specific one that makes it incredible right now. That ultimately, I think, Jordan, you're aware, hundreds of billions of dollars are about to flow into China, whether as an investment, whether it's a good idea or not. And so we're just going to try and beat that money there, and I'll explain that in a minute. But really, let's just back up a bit. The biggest opportunities happen when investor perception is different than reality. And in my career, I've never seen a larger difference between perception and reality than you see in China right now. And what I mean by that is, for example, my wife has never been to China. She's actually going to go with me in June for the first time this year. But my wife's perception of China is that China is the sweatshop to the world. That's where our T-shirts come from, and that's where low-end goods come from. But the reality is that's the perception. But the reality is that China can't compete in that way anymore. Bangladesh and Vietnam, for example, can produce T-shirts 90% cheaper than can be done in China. So the China that my wife has the perception of doesn't exist anymore. If you want to buy a decent, and I'm not talking anything special at all, if you want to buy a decent apartment somewhere near the central business district in Beijing, you're going to pay $1.5 million. Yeah. If you're going to buy in Shanghai, you're going to pay more than that. And in Hong Kong, even more than that. You can't be sewing up $2 T-shirts if your apartment costs $1.5 million. You know, the perception and the reality. And I would say that Beijing and Shanghai, but China's major cities are more advanced than any city in the U.S. And I'm not saying this to be a China cheerleader. I'm saying it's just the reality. And the perception is so much different than that today. So China
part of the perception, Steve, part of the worry that people have, the two things about China today. First of all, we're about to get into a trade war, which is going to hurt us, but it's going to hurt them. And the second thing is that there's a huge amount of leverage in China, that they've built this whole infrastructure and all these ghost cities based on an enormous amount of debt that's going to come home to roost, and supporting state-owned enterprises that are over-leveraged and have too much capacity. Those are two worries that people have about China. What would you respond to those?
Yeah, I think, the trade war is really going to hurt the U.S. more than it's going to hurt China. It's, to me, those are overblown fears. For example, the savings rate in China is off the charts. the savings to cover the debt is fairly extraordinary, and it's not a concern to me. It's not a concern to me. The bigger ideas. So the way I try to do things, Jordan, is I try to find the one thing that matters to a market. And for example, you may be familiar. My big theme was that the U.S. Fed was going to keep interest rates lower than people could imagine for longer than people could imagine, and that would cause stock prices and real estate prices to go higher than anyone could imagine. And so the one important thing was those low rates in the U.S. And there were so many arguments against why U.S. stocks could go up. Oh, they've gone up for so many years in a row. Oh, there's so many things going wrong in the U.S. Median incomes haven't gone anywhere. The debts are huge. This and that, and all those things are true. But the reality is that interest rates near zero for all of those years were causing booms in today in the stock market and in the housing market, and I think those booms will continue.
This is what you call the big melt-up, right?
So yeah, that's the big melt-up. It's based on so what I expect in the U.S. We're not talking China at this moment, but what I expect in the U.S. is that you ain't seen nothing yet, so to speak. Even though stocks have gone up for so many years, it's been an incredibly long bull market. With interest rates so low, I expect that this stock market will end in a boom like the NASDAQ.com boom of 2000 or like the housing boom. I expect what I call a melt-up in stocks. And it's really driven from investor fear. It's shocking to me. It's stunning. If you think of the investor psychology at the top of the housing boom, people thought no one believed you could lose money in housing in 2006. I know it sounds crazy today, but everyone was optimistic on housing. Every dollar that could possibly be invested in housing was invested. And when you reach that situation, it can't go any higher. There's no more money left to push things higher. Well, in the case of China, but also in the case of the U.S., most people are still fearful of the stock market. They are not over invested in stocks. We saw a little of the animal spirits in the Bitcoin boom that peaked in December, but that's the kind of boom that I expect to where everyone believes that you can't lose money in this idea, and that's the feeling at the ultimate top of a major bull market.
So we haven't had that, even though the market's pretty much been up for 9 years in a row for the most part. It still has a long way to go because of low interest rates and because a lot of money's still not in the market, is what you're saying.
That's exactly, you summed it up better than I could sum it up. I mean, that's exactly the situation. And it's stunning to me. It's not just individual investors are scared to put their money in. Institutional investors are scared. I mean, the list goes on of, I can quote all kinds of real money indicators and sentiment indicators that show that this is not what the peak of a market feels like. We haven't seen that yet. And before this is over, we will.
Let's go back to China. So what is the major event that's about to happen where this money is going to come into China and you want to get ahead of it?
Yeah, so it's a really big deal. I mean, it's the biggest deal of my lifetime. I never imagined a moment in my career where nobody would be invested in the world's second largest economy and the world's second largest stock market. China is the world's second largest economy, and it actually is the world's second largest stock market, but nobody is invested in it. Nobody. So why is nobody invested in China's stock market? Well, people probably have an idea that China's been a bit more closed off to the rest of the world than many other countries, right? So it hasn't been easy to invest in the local stock market, but that is about to change, and that's about to change starting on May 31. And what happens on May 31 is that China will be added to the major global stock market indexes. And you think, who cares? It doesn't matter. So what if a country is added to a global stock market index? Sounds like kind of a technical, unimportant thing. But it is huge because what happens is fund managers benchmark their portfolios to the world indexes. So what that means is if 40% of the world's index is the U.S. stock market, then global fund managers have 40% of their money in U.S. stocks. So ultimately, 18% 18% of the emerging markets index is going to be invested in China because of what I'm describing here. And it's big money. I mean, it is big money. It is hundreds of billions of dollars that's going to flow into China that has never flowed into China before.
Are there limitations on that? I mean, the A shares, I thought that there's still some limitations on how institutions can buy them.
So it is. So what's been happening is it's kind of been a back and forth between U.S. institutions sort of being afraid and China making it available for people to buy these A shares, which are the local Chinese shares. And so it's gotten easier and easier and easier. And the easy way right now is they've set up this little bridge between Hong Kong and China, so to speak, a kind of electronic bridge it's called the Connect. And it allows people to easily buy local Chinese shares through the Hong Kong Connect system. So you can buy shares that trade in Shanghai through Hong Kong, and you can, it's a relatively
so that barrier has fallen, you're saying, and that's going to allow institutions to buy Chinese local A shares.
Exactly, absolutely.
Yeah. So what would be a way to play that? Would you want individual stocks, or are there ETFs? What are ways to play the coming surge of money into China?
Yeah, it's a great question. We know exactly which stocks they're going to go into, but it is a bit challenging for individual investors to buy these local Chinese stocks. You would have to be able to buy them through Hong Kong, and it's just more work than you need to really go through. So there is a fantastic ETF for us to buy, thankfully. It's actually benchmarked to the MSCI China Inclusion Index. So it has the exact stocks that institutions are going to buy, that hundreds of billions is going to start flowing into as of May 31. And this is the Crane Shares MSCI China A Share ETF. The symbol is KBA, like Kevin Boy Alpha, KBA, and it tracks exactly what we want to own.
What has it done the last year or so? What has KBA done the last year or so?
Well, it's been up. I mean, investors have been sort of, what's happening is local Chinese investors, they get this. They know this is coming. So they've been pushing up local shares. And that, we have the ability to actually do this ourselves by buying KBA in advance of the money that's about to flow in. So let's see, I'm just getting a specific...
it's done okay, but it hasn't soared in anticipation of this, you're saying.
You haven't missed it for sure. And this week I actually, last week I actually spoke in Boston at the MSCI sort of inclusion seminar where MSCI is it was a roadshow being put on by MSCI to get the word out about what's about to happen at the end of May. And talking to the head of equities for a Chinese firm, sort of the Goldman Sachs of China. He's a friend of mine, and he was a fellow speaker. He said that no locals are really China's market is dominated by retail local investors, individual investors. They aren't buying China. Institutions are underweight China, meaning that they haven't bought enough at all. And U.S. investors are horribly underweight China.
Yes,
underinvested. So just to get to equal weight, just to get to the proper balance, I mean, it is going to be a flood of money. And the only way it goes up is, the only way they get equal weight, which is where they want to get, is by this money flowing into the stocks that are in this ETF right here. So KBA is a great place to be right now.
Excellent. All right, we're going to take another break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Steve Sjuggerud. He is the editor of True Wealth, which is a newsletter published by Stansberry Reseach. You can find out more at their website, stansberryreseach.com or dailywealth.com. We'll be back after this.
Stocks, bonds, investment opportunities, financial news, and talk. We can help. Call us now toll free, 866-472-5790. 866-472-5790. Voice America Business Network.
Attention heroes, current and former firefighters, law enforcement, military, medical, or educational professionals. Heroes can receive rewards averaging over $2,500 when they buy, sell, or refinance a home. Heroes come first. Along with the Homes for Heroes is the nation's largest hero reward program. Their mission is to provide extraordinary savings to heroes who provide extraordinary services to our nation and its communities every day. Learn how you can purchase a home for no down payment, no closing costs, and get money back at closing. Find out how you can own for less than you may pay for rent. Get your hero rewards at heroescomefirst.com. That's heroes, HEROES, comefirst.com. 888-437-6114. Jordan Goodman is an affiliate. He recognizes quality solutions, forming relationships to help improve the lives of his listeners.
Do you or someone you love have a life insurance policy that's no longer needed or not affordable? Did you know that you can sell your policy for cash? Your reason for buying life insurance has probably changed. Thousands of Americans turn to life insurance settlements to help sell their policies. They act as your representative, getting the highest market offer for you. You've got nothing to lose by simply inquiring. If you're over 64 with $100,000 or more of life insurance, you may already qualify. Call 877-485-6681 to get your free non-binding appraisal or visit fundinglife.com. Life Insurance Settlements. Discover the true value of your life insurance. 877-485-6681. Jordan Goodman is an affiliate. He recognizes quality solutions, forming relationships to help improve the lives of his listeners.
From the boardroom to you, Voice America Business Network.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Steve Sjuggerud. He is the editor of the True Wealth newsletter, one of the founding members at Stansberry Reseach. You can find out more at stansberryreseach.com, or the newsletter is dailywealth.com. Welcome back to the show, Steve.
Thanks, Jordan.
So you say that you like to buy things that are hated and out of favor, but still have some kind of a turnaround. One area you've been looking at recently is commodities, which in general have been dead for a long time. What is the driving factor in the turnaround of commodities, and how would you invest in them?
No, it's a great question, and you're right. I want to find assets that people are not paying attention to, and it's amazing that there's sort of a cycle of these types of things. And housing was the best thing in the world, and then nobody cared, and now it's good again. And so commodities have gone through incredible cycles where even the companies that I call the masters of the universe, the big names, the ones that own the largest, piles of gold, for example, Freeport or BHP Billiton or Rio Tinto, these are the companies I consider to be the masters of the universe. They're not going anywhere. But in a commodities boom, they will soar 400%, 500%, and these are the blue chips. But meanwhile, in the commodities busts, they'll fall 60, 70, even 80%.
Which is what's happened, right? I mean, they're down, way down from their peaks.
Yeah, so ideally you want to be able to. These are the best assets on the planet, like I said, and so you want to be in a position to say, okay, I want to buy these when they're hated, when they're ignored, when no one's paying attention to them. And let me tell you, I don't know if people are aware of this, but the premier commodities index these days, it's the Bloomberg Commodities Index, but it's gone through a few different name changes over time. But the Bloomberg Commodities Index is recently hit levels not seen since 1991. So
low levels, you mean? Yes.
Yeah, low levels in a bad way. Yes, it's
right.
It's as low as it's been in 27 years.
Yeah.
So if you're looking for a hated investment, look no further than commodities. And,
so why do you see a turnaround? I mean, if it's just hit its lowest level, it doesn't sound like it's turned around yet, or beginning to turn around.
Well, what I like to do is I like to see that the start of an uptrend. And while no one has been paying attention, the Bloomberg Commodity Index, it actually bottomed in early 2016. and it's steadily been rising. And so it's really right now we're just looking at we've got the three pieces, sort of the cheap, hated, and the uptrend. And to give you an idea, Jordan, just going back 2 years ago, I was at speaking at the Vancouver conference, the Sprott Natural Resources Conference, which is one of the major conferences on the planet. But it's as Jordan, you're probably aware, it's the premier sort of gold bugs conference.
Yes.
And they asked me to be the first speaker on the first day, and I told them I've sold all my gold and all my gold stocks just the week before I arrived at the conference. And the audience was shocked, and every subsequent speaker over the next few days had to say, well, Steve said that he sold his gold, but here's why you should still be buying gold. But at the time, gold was very popular, and gold stocks were very popular, and but since then it's been a struggle for them. They haven't done much, and it was the right thing to do to sell at that time. But now I think it's the right thing to do to at least start getting interested in.
So what would be the
commodities.
fundamental reasons why commodities would be going? I mean, oil has had a huge move from 30 or so up to about 70. Gold has moved up a little bit, not that much. Silver hasn't done too much. And you've got these potential tariffs, like on agricultural products, which would make the prices go down. Why would commodity prices turn around and start going up sharply?
I have a very long-term vision of this. I was, when you think about where we are, this is a big picture story here, Jordan. But when you think about where the U.S. is, we're in a position where we have an incredible national debt, and we also have an incredible spending problem in the U.S. to the point where spending on entitlements, Social Security and spending on entitlements and the national debt will exceed all government revenue in 15 years' time. Yeah. All government revenue. And so we have an incredible problem that we are really not facing up to. And there are three ways out of this problem. The first way would be to reduce government spending. Get rid of these entitlements and
not going to happen. Yes.
Not going to happen. The second way to get out of it would be to dramatically raise taxes. But the reality is that, and even if you could, you can't even raise taxes enough to cover the spending that we have committed to at this point. So I said there are three possible ways out. There's cutting spending, there's raising taxes, and the final one ultimately is printing money. Those are your three possible ways out of this. And this is a long-term view, of course, but my big picture view is that we are currently in this incredible boom in stocks. We have this. We can enjoy incredible gains that we can possibly make in the stock market and in the real estate market as we enjoy this melt up and this low interest rate environment. And it's kind of really a perfect environment to make money as an investor. But the flip side of the melt up is sort of the meltdown, as whether it's with an inverted yield curve in 18 months or 2 years' time. But I expect...
You're predicting inflation. When you have printing money, that's ultimately inflationary.
That's ultimately inflationary. So what I'm looking at in the very long run is... in the short run, I expect us to make a lot of money in stocks and in real estate and in other paper assets. But in the long run, I see that sort of a return to the 1970s of the major asset classes that did extremely well back then. And when you go back then, it's surprisingly, there's certain collectibles. Gold did extremely well, as you know, and a variety of different commodities did extremely well in the 70s, and other assets that do well. Timberland, for example, did extremely well in the 70s because it's an asset that not only goes up in an inflationary time, but the yield on it rises as well. So this is a long-term play. This is not a short-term turnaround, as you're talking about with China, something happening this month. This is definitely a longer-term play. And so how would you play it? What vehicles would you use to play the turnaround that you see coming in commodities? Yeah. So this is something that we're working on is I would want to own what I call the sort of masters of the universe of commodities. The BHP Bulletins of the world, the Rio Tintos, the Freeports. Let's see. I just want to get to.
Are there some ETFs that have all these in one place, or are there pure plays on commodities itself as opposed to the miners of commodities that you would like?
Yeah, so I would highly recommend the very simplest way to do it. What I'm talking about is an ETF with the symbol PICK. It's PIC is what is the name of it, which would be kind of like picks and shovels, right? So those are the masters of the universe kind of ETF. So those are the masters of the universe kind of ETFs. And so ideally what they would do is they would give you leverage to rising commodity prices. And they are really broadly spread out over the mining sector. And again, these things can make ridiculous returns in an up market, and they will lose money in a down market. So ideally, I believe that we'll have multiple shots at multiple, making 2 and 3 and 4 times your money on these over the coming commodities boom. But this is a 10, 12-year story.
Yeah. And specifically gold, what is your view on gold today?
Well, I have been a nibbler on gold personally. I've been buying gold itself. I have not bought any gold stocks. Gold is the ultimate crisis hedge, as they say, but we're not in a crisis. So I kind of accumulated outside of crisis, and it's going to be a major player if this inflationary idea that I'm describing comes up. But I don't consider myself a gold bug. I buy it when it's in an uptrend and when nobody cares about it. And
would you buy physical gold, or would you buy ETFs like GLD or gold mining shares? How would you play it?
Personally, I actually buy gold coins, which is physical gold, and I take possession of them. It's interesting. This is a long story, but I won't go into it. But GLD, surprisingly, you pay the same tax rate as you would on collectibles when you buy GLD. So you pay a 28% sort of capital gains tax on GLD, which is the ETF. You don't pay, your own capital gains rate. There's a specific 28% tax on collectibles, which is a bit crazy. It's different for that one security than anything else. But GLD is a perfectly fine way to own it in your portfolio or your IRA. I just happen to own the physical myself.
So just to summarize, a way to play the so-called masters of the universe, the Rio Tintos and the Freeport McMorans, would be PICK, which is an ETF with all these companies, and it's a long-term play as inflation comes back. We're going to go to a break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Steve Sjuggerud of Stansberry Reseach. Their website, stansberryreseach.com. The website for his specific newsletter, which is called True Wealth, which is dailywealth.com. We'll be back after this.
From the boardroom to you, Voice America Business Network.
Looking for an investment option? Consider Secured Real Estate Income Strategies. Secured Real Estate Income Strategies is a real estate-backed option offering investments with a monthly income objective. The goal of the strategy is to lend money to real estate developers. SREIS offers an 8% preferred return per annum, plus a share in any profits. While there is risk, including loss of capital, and you should carefully read the offering circular for full details, Secured Real Estate Income Strategy screens each real estate loan carefully. Call 888-444-2102 or visit securedrealestatefunds.com to learn more. 888-444-2102. Jordan Goodman is an advisor to and part owner in Secured Real Estate Income Strategies. This does not constitute an offer to sell or a solicitation of an offer to buy any securities. Securities offered through North Capital Private Securities, member FINRA, SIPC.
Are you a homeowner tired of making monthly mortgage payments with little progress towards paying down your principal? Does paying off your home in 5 to 7 years without making larger or more frequent payments sound appealing? Paying off your home in full in 5 to 7 years is really possible thanks to Truth in Equity's Mortgage Equity Optimization System, a money management approach that puts your money to work for you 24/7. If you own a home with some equity, have a decent credit score, and verifiable income, you owe it to yourself to learn more about Truth in Equity's program. There's no need to replace your mortgage or refinance in many cases. The system works for new home purchases as well as current mortgages. Your home is your largest investment. Own it outright in 5 to 7 years. Call Truth in Equity 888-262-5540 or visit truthinequity.com 888-262-5540. Jordan Goodman is an affiliate. He recognizes quality solutions, forming relationships to help improve the lives of his listeners.
Get the news on our shows and other happenings by following us on Twitter. Find us at VoiceAmericaTRN or twitter.com/VoiceAmericaTRN.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Steve Sjuggerud. He's a founder of Stansberry Reseach, editor of the newsletter True Wealth, which you can find out more about at dailywealth.com. The website for the whole company is stansberryreseach.com. Welcome back to the show, Steve.
Thanks, Jordan. Thanks for having me.
One of your contrarian plays is about interest rates. Now, right now, interest rates have been rising. Last week, the 10-year Treasury hit 3% for the first time in 4 years. Everybody thinks interest rates are going up. What do you think about that?
Yeah, I think everyone is wrong. I think interest rates are going to go down. And when you said interest rates specifically, you were talking about the 10-year bond or long-term interest rates, which are controlled by market forces as opposed to short-term interest rates, which are controlled by the Fed. And so I just wanted to be specific because the Fed is pushing up short-term interest rates, and that's a pretty clear thing that's happening. So I think that what happens is people get a little confused between long-term interest rates and short-term interest rates. They think, well, if the Fed is raising interest rates, that all interest rates around the world, or all interest rates, whether it's mortgage rates or 10-year Treasury bonds, they think all interest rates are going up. But it doesn't really happen that way. And the Fed is sort of, the government in a way sort of controls short-term interest rates while market forces control long-term rates.
So you agree the Fed's going to keep raising short-term rates, but you just think long-term rates are not going to keep going up as much as they have been lately.
That's exactly right. And it seems counterintuitive, but that's what a contrarian trade is really built on. And so where do I get this trade idea, and where do I get this belief? Well, really, right now, we have never seen a moment where investors have committed to this degree of betting on higher long-term interest rates. And no matter how you size it up, whether you're looking at the actions of futures in the futures market or what institutions are doing with their money, or just simple surveys of investor sentiment. The recent one was a global fund manager survey from Bank of America Merrill Lynch. Everyone is betting the idea that long-term rates could go down while the Fed is raising short-term rates does not even pop into people's line of.
Why is that? Why do you think that rates are going to go down? I mean, the arguments for rates going up are the economy is getting stronger because of the tax cuts. The Treasury has to borrow a huge amount of money to cover the deficits. All these other inflation's picking up in various ways. These are the reasons why people think rates are going up. Why do you think rates are going to go down, long rates?
Yeah, so that's a great question. And the thing is that it comes down to looking at what every other rate around the world is. That we don't just operate sort of in a vacuum. We have to look at what's happening around the world as well. And when you look at 10-year government bonds in other countries, it's crazy. And Jordan, I'm sure you're aware, in Japan, a 10-year bond is paying you 0.0% right now.
Yes.
0.0. And if you look in Germany, so these are the major bond markets of the world. 0.0% in Japan, 0.56% in Germany, 0.78% in France, 0.03% in Switzerland. So if you are a global investor and you're trying to decide what to do with your safe money, Do you want to earn 0% in Switzerland, 0% in France, or 3% in the U.S.? So it's a beauty pageant, and the U.S. is really winning. Money really wants to flow towards these high yields of the U.S. Meanwhile, U.S. investors, they have been betting on higher rates. There is no one left to bet on higher interest rates. All of the bets, we have never seen such an extreme as the size of the bets on higher interest rates in the U.S. So meanwhile, while the U.S. is the most attractive bond market in the world as far as safe countries, what I mean is they pay the highest interest rate. We are also seeing a moment where we've never seen more people betting against, never seen betting on higher rates than we see right now in the U.S. So there's
more demand is going to come in from overseas, and the supply won't be there to keep it, and that's why rates will fall.
That's right. We're going to have more demand because the U.S. is the most attractive, and meanwhile, all the bets that are possible have already been made. So when those bets start to unwind, U.S. rates are going to fall significantly.
Almost like a short squeeze in a certain way.
Exactly. That's exactly what's going to happen. And there's almost no way around it. So it's not typical for me. My main newsletter, True Wealth, is normally a very conservative letter and very, very clear ideas, very simple ideas. We don't sort of stick our neck out and make sort of riskier type bets very often. But in this particular case, this is just such an extreme, such an obvious opportunity that in this newsletter, we actually have a leveraged fund that would take advantage of falling long-term rates.
It's leveraged on bond prices going up, yields going down. So what would be
exactly right.
It's an ETF, or how would you play that one?
So that ETF, it's the Direction Daily 20-year plus Treasury Bull Fund, symbol TMF, as in Tom, Mary, Frank. And this thing
that's leverage. Is that 2 or 3 times, or is
it's actually 3 times leveraged?
Wow!
But of course, I mean, it's invested in boring bonds, so the 3 times leverage is helps you out in making big potential returns.
So that's probably been falling a lot lately as rates went up to 3%.
Right, and now is a perfect opportunity for people to get in. So the way I would recommend it, the way we're doing it in our letter is we have basically a 15% trailing stop on the downside, and we would recommend, what I'm doing is I recommend having 50% upside potential but 15% downside risk. So that's the way I love to trade. And Jordan, you've heard me say this before. I want to have 3 times the upside potential as my downside risk. So if you were going to trade this, you'd buy it today. You'd cut your loss if we were wrong at losing 15%, and you'd take your profit at a 50% gain, 50% gain.
We have about 2 minutes to go. Just kind of sum up your view of the world markets and what big opportunities you see and what risks you see in the market based on what we've talked about the last hour or so.
Yeah, absolutely. So I think investors are incredibly fearful. So I think we have a fantastic opportunity. There's still plenty of upside. I predict we'll see a melt up in U.S. stock prices over the next 18 months or so, much higher highs than anyone is ever imagining. I also believe real estate is going to do extremely well in the U.S. But my favorite idea is actually China and KBA, which is an ETF to buy local Chinese shares. China is the world's 2nd largest economy. It's the world's 2nd largest stock market, and nobody is invested there. Meanwhile, hundreds of billions of dollars are about to flow in because China is going to be added to the global indexes. So KBA is my top story right now.
And you're saying in the long run, the stock market has a long further to rise, but eventually we'll have a big meltdown after the melt up. Is that right?
Yeah. So these are just I don't know how clear my crystal ball is, but I figure we have maybe 2 years of upside in U.S. stocks. But the China story, to me, this is more of a 5-year story of upside. So if you were looking for a 5-year call for me, Jordan, it would be Chinese stocks.
So Chinese stocks will keep going up, but U.S. stocks will peak, you're saying, when all these pressures you talk about, these inflationary pressures, start kicking in.
Yeah, I mean, I think if the Fed raises short-term rates above long-term rates, that has been a classic sign of an impending recession and an impending stock market bust, really. I think inverted yield curve, which is short-term rates being higher than long-term rates, has predicted, I think they say 10 of the last 9 recessions and stock market busts.
But that's what you're saying is going to happen if you think long rates are going down and the Fed's going to keep pushing up short rates.
Yeah, I think we'll see short rates. We could very well see an inverted yield curve maybe 2 years out, and that would be a huge red flag. And it would be time to really start lightening your load in stocks and real estate, possibly, and start considering some of these other things that did well in the 70s.
Terrific. Well, thanks so much. My guest this hour has been Steve Sjuggerud. He's the editor of the True Wealth newsletter, part of the Stansberry Research Group. The website for that is dailywealth.com, and to find Stansberry at stansberryresearch.com. Thanks so much for an enlightening interview, Steve.
Thank you, Jordan. Had a great time.
And we'll be back next week with another edition of the Money Answer Show. Goodbye for now.
Thank you for joining Jordan Goodman and the Money Answer Show. If you have a question for Jordan, please visit his website at www.moneyanswers.com. And be sure to tune in every Monday at 12 p.m. Pacific Standard Time right here on Voice America Business. See you next week.